Michael Hauser with Hauser Financial Coaching. Protect your family, but do not make this multiple six-figure mistake. Risk management is critical to your and your family's finances. One component of risk management is life insurance. If you have loved ones who depend on your income, life insurance is a necessity.
Before we compare types of life insurance, let's look at less frequent situations that require further consideration. Someone who does not qualify for a type of life insurance, or someone who has more assets than the federal estate tax exemption. For the 2024 tax year, this is $13.61 million for an individual or $27.22 million for a married couple.
Let's compare two common types of life insurance, whole life and term life.
The purpose of life insurance is to replace your income for your family if you die. Both whole life insurance and term life insurance accomplish this. With whole life, the coverage period is your whole life, if you keep paying the premiums. With term life, it is a set term. With level term life, you pay the same premium each year of the term, and the death benefit does not change. A key concept of whole life insurance is that you need life insurance for your whole life. In reality, you only need life insurance for as long as your family is relying on your income.
By eliminating debt, building a fully funded emergency fund, and investing, the need for life insurance for your whole life is eliminated. Whole life insurance is a permanent solution to a temporary problem. A main sales pitch for whole life insurance is its cash value. Here are 3 key facts about cash value that whole life insurance salespeople are not eager to tell you.
The entire premiums do not go to the cash value. Only a small portion does. The rest go to the insurance itself and expense charges. How can you access the cash value? One way is to take out a loan against the policy, in which case you would be paying interest to the insurance company. And if you borrow against the cash value, the loan amount will be deducted from the policy's payout when you die. Another option is to surrender the policy, in which case you would no longer even have life insurance, defeating the whole purpose of life insurance. And if you die with whole life insurance, your beneficiaries will only receive the death benefit. The insurance company will keep the cash value. As you can see, there is not much actual value in cash value.
Your goal with life insurance should be to get the greatest benefit at the lowest cost. Since both whole life and term life insurance equally achieve the main purpose of life insurance by replacing your income for your loved ones during the years that they're relying on it, we can now focus on comparing costs.
Let's look at examples of $500,000 policies for a 30-year term for a 30-year-old. For a female, whole life insurance costs $4,896 per year. Term life costs $414 per year. A difference per year of $4,482, and a difference for 30 years of $134,453. Whole life insurance for a male costs $5,664 per year. Term life costs $509 per year. A difference per year of $5,155. A difference for 30 years of $154,638. whole life insurance costs 11 to 12 times as much as term life for the exact same policy amount. Now, $134,000 and over $154,000 are huge amounts of money. But that is only part of the story. What if instead of buying whole life insurance, a person bought term life insurance and invested the difference between the two in retirement? By the age of 60, at the end of that 30-year term life policy, a female could have $737,000 and a male could have just under $848,000.
Yes, that one decision could cost you about $750,000. Listen, the only people who recommend whole life insurance are whole life insurance salespeople. Whole life insurance is trying to do two things at the same time. It is trying to be life insurance and an investment account. By trying to do too much, it does neither well. It is a savings gimmick with a poor rate of return. Your life insurance should be life insurance. Your investments should be investments. Here are guidelines for purchasing a term life insurance policy.
When switching from whole life insurance to term life insurance, first get a term life insurance policy in place and make sure that it is full and in effect before canceling your whole life policy so that you do not have a gap in coverage. Also, determine if there are benefits that you can utilize before canceling your policy. I recommend that the death benefit be 10 times your annual income plus any outstanding debt. As for the term, I recommend that the end of the term is the latest date of having a fully funded emergency fund, becoming completely debt-free, including paying off your mortgage, the time when your children will become financially independent, and the time when you become financially independent.
As your financial coach, I will help you know your numbers and avoid traps and gimmicks so that you can manage risk while also building your wealth. Schedule your free financial coaching consultation today to get started on the path toward your financial success.